The Dow and S&P 500 closed higher after this morning's inflation report for October was in line with expectations. But just moments ago at Delivering Alpha, hedge fund investor David Einhorn said inflation risks are not yet off the table.
We have increased our bets on inflation. I think that we're going to have another inflection up inflation. I think that what the policy mix that is being proposed, I think it is inflationary. And I think that that we'll see more of that over the next few years.
Well, joining us now is Claudia Sahm from New Century Advisors. She is also a former economist at the Federal Reserve. Claudia, it's great to have you back on the show.
Great to be back.
I want to get your response to that. The Einhorn comments just now, especially in light of the CPI report we saw this morning.
So after the past 4.5 years, if anybody's still holding out hope for smooth sailing, I mean, I've got news for you, right? Like this is a bumpy ride. And absolutely, we should be attentive to risks of inflation coming back. If there are big policy changes, then we are going to have to step back, analyze them in their details, and really think about what the numbers look like. So, but what's really important is not to lose sight of we have come out of an extremely disruptive, high inflation period. And while we're not all the way to the finish line, we have made an immense amount of progress. And it really does push the conversation about when inflation rears its ugly head, what do policymakers do?
So I'll start right there. What do policymakers do? Because it does seem like the market is pricing in another cut come December, and maybe perhaps the data we got this morning reinforces that. But we have heard from a number of Fed officials, including, I think, 4 of them today, who sound a bit more cautious about maybe not December, but what 2025 looks like and ultimately what neutral rate looks like.
Well, being cautious is part of the job description of getting to be a central banker, right? Like you don't want people in there who don't take inflation risk seriously. And at the same time, we can't live in the fear of the unknown, right? We have some positive things going for the economy. We've had a lot of growth, and a lot of that growth looks like it's higher productivity, it's more labor supply. It are factors that aren't inflationary. As long as we can keep up with the demand, bring on the demand. Right? Like it is not a problem. What's a problem is when we, get out ahead of ourselves and the supply either pulls back or just can't keep up. So I think there's every reason to be cautious. The Federal Reserve largely is a risk management institution, right? And so they're paying attention to the risks, and they're also going to follow the data. I thought it was quite remarkable for Chair Powell very clearly to say over the near term, which the Fed thinks of as kind of the next 6 months, the next 9 months, the election is not an event, right? They're looking at the data. We're still trying to work out through what's already happened over the past several years in terms of inflation. So I thought that was pretty remarkable. They're not letting the risk take over their thinking right now, but they are aware of it.
So what are you seeing, since you do so much economic modeling around this, what are you seeing in terms of the labor market, especially since after the last Fed decision, Chair Powell was pretty clear in saying that he sees a labor market that is now, I guess, a bit looser or not as tight as it was pre-pandemic?
Right. If we could freeze frame on the labor market right now, it would be pretty good. It's not good enough. Like the hiring rate is too low. It is much more difficult to get a job than it is to keep a job right now. And that's a problem in terms of the talent that we're putting on the sidelines because they're not getting jobs. So there are some issues in this labor market. But by and large, if we could keep in this place, that'd be really good. That would be really close to a full employment type economy. And yet the problem, and the Fed has become very attentive to this, the problem is things have been softening, and they've kept softening after the point where really the inflation risks have gone to the side. Like the wage growth, yes, it's elevated, but productivity is elevated. And so that's this kind of, we don't want to lose much more ground. And frankly, the Fed and the tools that we have, if things really start to slide in the labor market, it's hard to stop that slide. And that's what they're trying to get ahead of. And that's absolutely appropriate, particularly because inflation has come back down so much closer to target. They have a dual mandate, but they got to pay attention to the side of the mandate that's having some trouble or looks like it might have some trouble around the corner.
Okay, we'll have to see. Claudia Sahm, thank you.